Now, it seems simple enough, except that you need to specify various different parameters. And so in our original paper, we got parameters from the industry. We knew nothing about the underlying mechanisms of drug discovery and development. So we look at publications of what it costs to develop a drug, the historical data for revenues, and we simulated a 7-state Markov chain to simulate going from phase 1 to phase 2, phase 2 to phase 3, so on and so forth, and then structured a megafund to try to capture these kinds of dynamics. So just to give you a sense of the data that we used, we were able to collaborate with Tufts University. They have a data set of cancer compounds. Our original focus was on cancer for both personal and statistical reasons. Personal in the sense that all 3 co-authors were dealing with family members that had cancer, so we had a personal interest in this. And from a statistical reason, there are lots of different cancer compounds. Cancer itself is not one disease, it's many different diseases, so we thought we'd get diversification naturally. The Tufts database had 733 anti-cancer compounds in its database, and these are the statistics of those 733. So we basically looked at that data and used those statistics to calibrate our simulations. So this is our 7-state Markov chain, and probabilities of success varied across different papers. So we just pulled them out of the various different publications, and we ran 2 simulations. The first simulation was from preclinical to phase 2, the early stages, and then a second simulation was phase 2 all the way to NDA. And we broke it up because we were told by industry experts that nobody really develops a drug from beginning to end anymore. That really the way drug development happens is the early stage is done by biotech and VCs, and the later stages is done by pharma. So by the time you get phase 2B approval, at that point you sell it to pharma. Pharma takes it from phase 2B all the way to NDA. So we just did 2 different simulations, and what we found really blew us away. We found that for the early stage fund, which we scaled at about $5 billion, that the equity tranche earned a rate of return of about 8.9%. And then the debt tranches, we assumed, were paying 5% yield and 8% yield, which in our view was quite generous. That was higher than the market rates for bonds of the equivalent risk at that time. And for the later stage of phase 2 all the way through NDA, that was a $15 billion fund. You need more money now because you're in phase 2 and phase 3. The $15 billion fund earned on the equity side a rate of return of 11.4%, and the bond risks were commensurate with the risks that we saw out in the industry for the appropriate ratings categories. Now, 9% and 11% may not be great returns from the point of view of venture capital. But I got to tell you that from the perspective of a pension fund, a mutual fund, an investment by a retail investor, these are great returns, especially at scale. We're talking about $5 and $15 billion pools of capital. And so this was the first time we thought that, gee, this idea might work. But still, there's lots of different elements that we didn't understand. So our approach was to try to get many experts together to study this.